over the last 15 years, we've seen the millennial generation actually grow their wealth dramatically. And that owes to a few things. And actually, the truth is, it's only just starting to be because of the intergenerational wealth transfer. The biggest thing is, honestly, we've been in a ripping job market and equities market. And part of that is we've seen a massive increase in that generation investing, right, in the sort of public markets and in the markets overall. And that sort of discipline of investing and the adoption of investment products has grown for that generation more than any others.
It's called the generational wealth transfer. As much as $84 trillion in stock, real estate, and other assets moving from the hands of baby boomers to the next generation of younger investors over the coming 2 decades. With so much wealth being passed on and so many new investment options available at the tap of a smartphone screen, how should younger investors adapt? What challenges and opportunities do they face? What education is required to ensure they can grow and protect the wealth they're inheriting and adding to in the years ahead? I'm Mike Larson, host of the MoneyShow MoneyMasters Podcast. To get the answers to those questions, I've invited a new guest on today. He's Stephen Sikes, Chief Operating Officer at Public. Stephen, welcome to the show.
Yeah, thanks for having me, Mike.
Great. Glad you could be here. I mean, I do want to talk about this big picture trend that we're starting with. $84 trillion is an enormous amount of wealth. And as it moves from the baby boomer generation to the hands of millennials, Gen Z, and so on, what impacts is that going to have and what questions does it raise?
Yeah, it's a great question, I think, for stepping back for the audience. So just want to introduce Public real quick. So Public, we're an investing platform that serves sort of the broad spectrum of retail investors. You know, we started as an app-based platform. Now we sort of serve through the full online brokerage capability. We've made our mark by building a brand that our members can trust and making a bunch of business decisions that sort of demonstrate our alignment with our customers' interests and building out a really great multi-asset platform. So we're sort of the only platform where you can trade stocks, ETFs, crypto, options, and bonds, both corporate and treasuries, on your phone, in your browser, on your desktop, et cetera. And so I think, we've sort of built an interesting niche that serves, obviously like a younger investor, right? We serve people that want to do their business online. So I think it's like, we tend to see the delineation of like, quote unquote, people that grew up with the internet versus people that don't. I say that, and then at the same time, I tell you our average customer age grows by more than a year every year. So we're certainly appealing to a broader spectrum of customers over time. And I think we're seeing a broader group of investors wanting to do their business the way we do. And so I think that's the population we serve. And we've really defined that sort of niche there. And I think that puts us in a position to sit at sort of the intersection of this one trend of financial services moving completely online and this sort of intergenerational wealth transfer that we're starting to see, right? And I think we absolutely have some customers who are sitting on the older end of the spectrum that are trying to plan for how to have their assets move on to the next generation. And then we also represent a very large portion of, sort of the retail investor base that are sort of thinking about how to manage their wealth as it grows. I think as we think about the intergenerational wealth transfer, I think about it slightly differently, right? Like that's intergenerational wealth transfer is sort of the industry term that's come to popularity in the last like 10 or 15 years. And I literally think we've been talking about this for 10 or 15 years, which is interesting in its own right. But I think about it a little differently. It's not just the intergenerational wealth transfer. I think what we're seeing, and this is borne out by a variety of studies and data, is that the sort of millennial generation, right? If we look at that sort of 15-year birth period that defines the millennial generation, that generation is both larger, right? It is not as large in terms of number of people as the baby boomer generation, but it's quite a bit larger than both Gen X on one side and Gen Z on the other. So in terms of the number of people, it's quite large. But also, it is at this age point in the generation, it is the wealthiest of any generation, right? To include baby boomers, which I think is a bit of a narrative violation from what we've heard industry-wide, is that millennials, we grew up during the great financial crisis. It was tougher for us to get jobs. We grew up with more student debt. But what we've seen is actually since that point, over the last 15 years, we've seen the millennial generation actually grow their wealth dramatically. And that owes to a few things. And actually, the truth is, it's only just starting to be because of the intergenerational wealth transfer. The biggest thing is, honestly, we've been in a ripping job market and equities market. And part of that is we've seen a massive increase in that generation investing, right, in the sort of public markets and in the markets overall. And that sort of discipline of investing and the adoption of investment products has grown for that generation more than any others. And that owes to two things. One, companies like us, right, platforms making investing more engaging and accessible. Yep. The second is the 401k, right? And I think we've seen a massive increase in sort of adoption of 401ks and employers and other sort of employer-sponsored taxable accounts, tax advantaged accounts, and the auto enrollment of employers automatically enrolling their customers in those sort of savings programs. Yeah. So those things have combined to just have the millennial generation is by far the furthest along in terms of its investment habits overall. So I think that's important context for now starting to think about. We are now in the process of starting to see some of this intergenerational wealth transfer, and we're just in the foothills of that trend, which we expect to grow pretty dramatically over the next 2, 3, 5, 10, 15 years. It's just going to be a step up because, again, intergenerational wealth transfer is driven by the passing of the later generation, and actuarial tables will tell you we are still in the early stages of that sort of baby boomer generation passing wealth. But it's ticking up. And so I think the considerations for the industry are, one, service model, right? Which is, hey, how do you interact with customers the way they want you to do business, right? Yep. And so that's having great user interfaces on the phone, on the website, et cetera. But it's also, hey, have an interaction model with their service provider, right? So there are plenty of situations where customers don't just want to be able to do it themselves, right? They need some help. They need some education. They need some other information. And some people really want that content and be able to read it themselves. Others want to be able to reach out. And again, I'm generalizing here, but I think as we look at younger generations, they are less prone to pick up the phone, right? I think, the generations that have grown up on the internet tend to, sort of want to text. They want to operate that way. They want to do things more asynchronously, and they want problems solved that way. And they want, rather than sort of picking up a phone, or they want to do it in real life, right? Which I think are the interesting sort of, separation there. They want to be able to see people and interact with them and have a real experience, or they want to do it in a completely hands-off text-based way. That middle ground of phone service, probably is one that we'll see relatively less adopted than we have seen with prior generations. So that's an interesting interaction model question. The second thing is being able to meet the full product needs, right? Mostly the millennial generation and the generations that we expect to be inheriting wealth have mostly been in sort of the earlier stage of their investment life. They're certainly more focused on equities, right? Again, I think if you look at any asset allocation over somebody's life, it starts very heavily equities and then it ends very heavily fixed income. So we're in that sort of swinging point where these generations, both Gen X and millennials, are starting to increase their fixed income allocations, which we as a platform think is really interesting. And we're trying, we are ahead of that curve and increasingly building a fixed income platform that works the way that retail investors expect it to. Again, it looks and feels a little bit like investing in stocks, despite being a very different asset class. And so we're building in that direction as we see sort of the asset allocation needs change of these generations.
Got it. And I definitely want to touch base on that. That's an interesting product thing that is out there now. Before I get to that, let's talk a little bit about the learning process for this generation of investors and how it's different from, I'm a Gen X or, me or the older generation above me. How are investors today learning differently? And, how are you guys servicing them on your platform and at live events for that matter?
Yeah, I think we've, first of all, I think we've never seen a more educated, empowered class of investors, of equity, especially equities investors, right? There's never been more information, more content, more research, more analysis, and better tools for retail investors to evaluate the markets. And I think that's leading to this generation of investors feeling more confident making their own decisions, which is an interesting takeaway as we think about this playing out in the context of the intergenerational wealth transfer, right? I think on a general basis, we expect to see a change in distribution of assets between self-directed and sort of managed products over the next, as this generation inherits that wealth. So we do see flows from sort of the investment advisor RIA highly managed space into more self-directed because of the explosion of this, content research tools, et cetera. And I think, you asked the question, how do they learn, right? And I think it's my experience of having been doing this for 10 years, interacting with retail investors, is two things. They learn two ways. And I'm generalizing here, but the two biggest, right, which might be a little different than people expect. One, People learn by doing, right? And so the generation of retail investors, the millennial generation, Gen X, that have grown up with great investing services online, have learned a ton through trial and error and just learning and interacting with the platforms, the 1.0 discount brokerages and, through to sort of our generation of investing platforms, they've been exposed to more asset classes and better data, and they've learned by ingesting that. Again, people are smart. They figure it out, and they like to learn by doing. And when they start to put money on the line, they have a real incentive to really understand what's going on. And we've seen, again, a lot of investors really get up that learning curve quickly on a variety of asset classes. The second, right, is they learn from the people around them. Right. And I think it's like they talk to friends, they talk to family. As the markets and sort of become interesting and they come into the public consciousness around big market events. Like we've got Fed meetings and Fed cuts and rate cuts. Like people are starting to talk about fixed income and things like that around the dinner table. And if you combine like sort of the market events with the growth in adoption of these products, both, of investing products within these generations, it becomes much more common for those conversations to happen over dinner, over brunch, right? At the barbecue, at their kids' soccer games than it ever has before. Because, it used to be that 1 in 3 people were investing in the stock market, right? With prior generations. Now it's like 2 out of 3 or all 3. And it depends on the population you're working in. But I think for sure, that adoption curve has led to these conversations and people sort of learning through interaction, right? Absolutely, people go and, the third thing, people will go and find ways to, consume online content. They'll read FAQs, they'll read Investopedia, et cetera. But I think we see far more impact when we find places to interact with people in real life and when we build great interfaces for them to learn by doing.
Got it. I'll tell you, all this talk of barbecue is making me hungry, unfortunately. I'll see if I can hold it together for a little bit longer. We've seen changes in the type and quantity of investments that are available in recent years. I mean, fractional shares, zero DTE options, alternative investments. I mean, people can get music royalty, income streams now. What kind of questions does that raise, and what kind of opportunities does that give for a retail investor?
Yeah, I think we've never, like I said earlier, we've never given more access to a broader set of investing tools to retail investors than we do right now. And I think what we're most excited about in that, right, is I think giving them the ability to build their full portfolio, right, their full asset allocation themselves in a way that makes a lot of sense, and being able to do that, by directly accessing the vehicles, right? So I think about that mostly where we've had the most impact is on the fixed income side, right? I think before we started to invest in this space, your options for investing in fixed income were mostly buying an ETF, right? Which can be great fixed income products, but they have trade-offs versus sort of directly investing in the underlying bonds, right? So, all of the direct indexing conversations that we've had about fractional shares and how beneficial it can be to directly index versus sort of buying the full ETF, right? That now applies to the fixed income world as well. And on top of that, like the bond funds and the ETFs that exist are all what we call sort of, they're like set duration tools. So you buy into a bond fund and it has a 4-year duration. The manager of that bond fund is going to try and maintain 4-year duration over time. So you're not following the rate curve. You're staying at that 4-year duration. And what we find is a lot of people, for their asset allocation, for their personal lives and their financial lives, they want to have a set duration. They want to say, okay, I need this money in 4 years. So I would like to give the money here. I would like to get a defined return over those 4 years and get my money back in 4 years. And that, it's kind of like retail investors tend to think about that as being like a CD, which people really like CDs, right? Bonds work the same way. It's just we've never actually given retail investors access to bonds in a way that makes sense so that they can understand, oh, there's this other thing that works just like a CD or very similar to a CD. Obviously, it comes with different credit risk and duration risk associated with it, but it's going to give you, it can earn you a higher yield than sort of your bank-backed CD. But the mechanics are the same, and they can play a meaningful role in people's asset allocation. So I think that, to me, I think where we've arrived in the industry is a place where retail investors can build that full asset allocation and buy options and sell options against that portfolio, and can do it sort of fractionally across the full spectrum of equities and fixed income.
Yeah, okay. I'd be remiss if I didn't ask a little bit about the market environment and what we're seeing here. Obviously, by the time this is published, we'll know how much the Fed cut by. We're going to be in the midst of this cutting cycle, probably into 2025. What opportunities and risks does that set up, and what else are you seeing in terms of people talking about the rotation we've had in the market, maybe kind of out of the big tech trade and into some of these other sectors to play catch up?
Yeah, I think the first thing, the rate cut cycle is going to impact directly how much people earn risk-free on their cash, right? We've already seen that get priced into the treasuries market. So people that manage their cash by buying treasuries have seen those rates fall from 5.6 on the 6-month to 4.6 on the 6-month, literally in the last, year. And that's been pretty dramatic. We have not seen that same rate impact happen on the sort of bank savings side. And I think we know a lot of people save money in their bank, high yield savings accounts. And so if we see, we're here on September 17th, on September 18th, if the Fed cuts 50 basis points, we're going to see that flow through everyone's high yield savings accounts, lockstep. So if your bank's paying you 4.6, right? Great job. That's a good rate. We pay at 5.1, but if you're getting 4.6, I can't argue with you. That's about to be 4.1%. And so I think when people start to see, okay, treasuries right now, 6-month treasuries at 4.6, bank rates are, we're at 5.1. Pretty quickly, those two things are going to come in parity. And so we're going to see a rotation from sort of that bank-based savings into treasuries and bonds, because the bond market and the treasury market is already pricing in these rate cuts that the bank market hasn't. So that dynamic on the backside of the rate curve is going to be very, very, very interesting to see how that plays out. And that's going to unlock a lot of capital that's been pushed into these high yield savings accounts at amazing rates that's now going to come back out and again be invested in fixed income and the equities markets and really the full spectrum of assets. So that has very much sucked a lot of those high yield savings accounts have sucked money out of the sort of capital markets, and we're going to see that flow back, which is really interesting. So that was your first question. The second, on the rotation, that's a tougher one to answer, right? Yeah. We certainly have seen small caps rally a bit versus large caps. We've seen some of the tech trade taper off and some equalization across the sort of S&P 500 in terms of, how much of the gains are being driven by the Mag 7 versus the rest, the other 493 names. I don't know, right? Yeah. I think we are privileged in this country and in this market to have 5, 6, 7 of the most amazing companies ever created that deliver phenomenal products to consumers that everyone loves and are breaking new ground on amazing technology like AI. And I think we all, as Americans, should root for that to continue, right? And I think we, as consumers, we should all root for that to continue. And I think a lot of returns are going to be aggregated in those firms because they are modern marvels. And so I don't, I try not to make short-term bets on the way these sort of things are going to play out. But I would say those companies have earned their returns by delivering great products to customers and great results for their shareholders. And I'd be hard-pressed to bet against them.
Got it. Stephen, just as we get ready to wrap up here, you're going to be speaking at the Money Show in Orlando this October. You're going to have also your director of product, Emily Kurtz, talking there about options. You have a sneak peek about what you think you guys might be covering and what investors who attend your sessions are going to get out of them.
Yeah, I think the two things where we've pushed the ball furthest forward, again, we talked about it already on this podcast a little, the fixed income market and helping retail investors understand how to invest in bonds. I think that's, and the tools that are available that we've built to make investing in bonds more similar, directly in bonds, make it more similar to investing in stocks. I think the second thing is just how to play and think about the intergenerational wealth transfer, right now to think about the asset allocation decisions that, on both sides of the wealth transfer. And then the third is we've got sort of the market leading options platform now, and we've earned that position by offering a novel rebate to retail investors that do invest and trade options, right? So on every contract, there's no per contract fees, no commissions, and on every contract you get a little bit of money back on the trade. And we, built the system that way to make sure that we're always giving our investors the best deal across the products we offer.
Got it. Well, Stephen, thank you so much for your insights. Viewers, if you're checking this out, you want to learn more from Stephen and his team, he is going to be speaking at the Money Show Orlando. It runs October 17th to 19th at the Omni Orlando Resort at Champions Gate. You can find more information on the event in the link below. And again, if you like this video, don't forget to subscribe to all the updates that we do. Stephen, thank you so much for taking some time out today.
Thanks for having me, Mike.
You got it.